If you bought a UK home last year, you are paying £950 more every single month compared to 2021. Not per year, per month. And yet, despite facing the biggest affordability shock in a generation, the housing market hasn't collapsed. To understand exactly why, we have to clear up a major misconception. This visualization shows the difference between a correction and a crash. A correction is a normal market cycle where prices fall 10 to 20%. It hurts, but markets do this. A crash requires prices to drop 30% or more. The UK last saw crash mechanics in 1992, defined by mass repossessions and economic devastation. The media often uses these two terms interchangeably, but treating a standard correction like a catastrophic crash is exactly what pushes homeowners to make panicked, disastrous financial decisions. This graph tracks the 2-year fixed mortgage rate. In early 2022, it was 1.6%. By October, following Bank of England hikes, it rocketed past 6%. For a £300,000 property, that rate spike translates into a £950 jump in monthly repayments. As borrowing costs soared, buyer demand evaporated. Sellers were forced to cut prices, resulting in a 15% drop in real-term property values once adjusted for inflation. That 15% drop is a heavy blow, but given the sheer mathematical weight of the rate hikes, the real mystery is the underlying structure that stopped the market from falling any further. The first shock absorber is physical scarcity. Successive governments have set a target to build 300,000 new homes annually. Last year, the UK managed just 234,000. This is a chronic 40-year failure. Because we have built so few homes for so long, the baseline need for shelter remains massive. Even when active buyers drop out of the market due to high rates, that underlying demand never vanishes. The second absorber is time. The vast majority of UK mortgage holders are on fixed-rate deals, typically locked in for 2 to 5 years. When rates spiked in 2022, most homeowners didn't feel the pain immediately. Their monthly payments stayed exactly the same. By staggering the financial shock over several years, the UK system actively prevents the sudden wave of mass defaults that trigger true crashes. Chronic housing scarcity limits the available supply, while staggered mortgage timelines delay the financial stress. Together, they act as a mechanical floor, successfully absorbing the initial impact of the rate shock. Real property crashes share one strict mechanical requirement: forced selling. And mass forced selling only happens when widespread unemployment strips families of their income. This chart compares the economic environments. In the early 1990s crash, unemployment hit 10.7%. Families couldn't pay their mortgages, banks foreclosed, and prices collapsed. Today, the UK unemployment rate sits at a highly resilient 4.3%. The fourth pillar is a shift in banking regulations. In the 1990s, banks foreclosed fast to recoup their cash. Today, UK lenders are legally required to work with struggling borrowers before moving to repossess. By offering mandatory payment holidays and restructuring deals, banks stretch the timeline from financial difficulty to foreclosure. This actively slows down the flow of distressed properties hitting the market, completely removing the severe downward price pressure. Without mass job losses, and with banks legally forced to negotiate, the specific mechanism required to collapse the market simply cannot activate. The fifth structural support is entirely invisible to all traditional economic models: emotion. Selling a stock takes 30 seconds, but your home is where your children were born, and the first place that ever felt completely yours. Families will absorb enormous financial punishment, cutting back on every other expense for months or years before they surrender their primary residence at a loss. It is highly irrational human endurance, and it removes sellers from the market at the exact moment economists expect them to flood it. These pillars are strong, but 3 genuine vulnerabilities remain. Risk 1 is the mortgage cliff edge. Millions who took out cheap fixed deals in 2021 and 2022 are remortgaging now into much higher rates. Those who cannot absorb the jump will sell, which could push prices down in specific neighborhoods. Risk 2 is the affordability ceiling. In cities like London and Bristol, prices are so high relative to local incomes that first-time buyers are effectively locked out. A market without new buyers slowly erodes its own foundational support. Risk 3 is the unknown external shock. No model can predict an unforeseen geopolitical crisis or a sudden global credit freeze. The UK property market has proven highly structurally resilient, but resilience is not the same thing as being bulletproof against concentrated systemic stress. To get a true 30% housing crash, you need a very specific cocktail: high unemployment, a severe credit crunch, and mass forced selling. Right now, none of those macro conditions exist in the UK. We are experiencing a standard, painful correction, but we are nowhere near a collapse. Here's your 3-step defensive playbook. First, check your exact fixed rate expiry date. Second, stress test your current payments at today's rates, plus an extra 1%. If you can handle that, you are secure. Third, stop making decisions based on clickbait headlines. That £950 penalty we started with, that number isn't a market crash. The market won't crash your home's value, but missing your personal remortgage window will cause a private financial crisis. If you want to know exactly what to do when your deal expires, watch my full breakdown on Bank of England rate decisions next.